Good day, and thanks for joining us for our webinar on Indiana farmland values and cash rents. I'm Jim Mintert, Director of the Center for Commercial Agriculture here at Purdue. And joining me are my colleagues, Dr. Craig Dobbins, who's a professor and extension economist in the Department of Agricultural Economics, along with Michael Langemeier, who's a professor and the Associate Director of the Center for Commercial Agriculture here at Purdue. So the Indiana Farmland Values Survey has been around for a long time. The Department of Ag Economics has been conducting this survey, I think, since the 1970s, Craig?
Yeah, I think it got its start in 70 or 71, something like that.
Okay. And you've been running it yourself personally for a number of years. That goes back how long?
I really don't know how long far back that goes.
Quite a while. Quite a while. So you've been focused on land values for a good chunk of your career,
yes,
I guess
right.
is kind of my point there. All right, so let's take a look at the survey and kind of go from there. So here's the survey conducted annually since 1970. Give us a few details about who you actually survey, Craig.
Okay, so when we do our survey, we make an effort to contact people that are involved in the Indiana farmland market as a part of their career in one way, shape, or form. And so we contact professional farm managers, we contact farm appraisers, we contact people that work in the credit industry, both for community banks or local banks and also the farm credit services. And of course, we also include some farmers in this survey. So that's who we're asking questions of. And you know, some of these questions are a bit challenging, as you might expect, when we start asking about, you know, where are things going and that sort of thing. So we asked them questions about what land values were in December of the prior year. We do this in June, and then we ask them, okay, what are they now in June? And then we ask them to give us an indication of where they think they're going to be come December of 2019. So we ask them to look a little backwards and a little forward. And we ask them for their estimates of value by the three qualities of land: top, average, and poor. And in order to get a little bit of a measure of what that means in terms of how much gets produced on those acres, we ask them to tell us what they think the long-term average corn yield would be for top, average, and poor quality land. So that's our measure of quality in this. And then we also ask them about what the cash rent, where the cash rent's at as of June of the year that we're doing the survey.
So their cash rent estimate is cash rent for the current year, in this case, 2019.
Yes, that's right. Yeah, so we get a current year number.
Okay. So Indiana farmland values, the big change was, Craig?
We had some decreases, which may not be all that surprising, but we had top quality land going down about 5%. Average quality land was a little less than 1% down, and the poor quality land held even. When one looks at it on a percentage basis, I think there was about a $2 difference or something like that on the low quality land. So the 5% decline is fairly significant in terms of changes in farmland values, either up or down. And so that was a little bit of a surprise this time in the survey.
Yeah, so we talked about this before the program, Craig, and I think you made the comment that on the way up, when farmland values were increasing, the top quality land was increasing at the fastest rate. Is that correct? Yeah,
that's right. So when things were booming, things boomed a little more with regards to top quality land, and then, you know, average was kind of in the middle, and then poor quality land kind of lagged behind both top and average. So yeah, top quality land was more responsive on the way up, and it's been more responsive on the other side of the hill.
Okay. So let's take a look at the 6-month changes, because you have a December survey as well, and bring that into perspective for us.
Yeah, so in December, people reported to us that things, for the most part, were up a bit, at least for average and poor quality land. Things were down a bit for top quality land. So again, this is part of that difference in response that we have. And so the first half of the year was a bit more positive than the latter, or the first of this year. So I got to get my years straight here. So the latter part of 18 there was still more strength in the market than there was in the first half of 19. So we got some small declines in the first part of 19, and in some cases the declines were enough to offset the increases that occurred the first 6 months.
So let's take a look at land values from maybe a little longer term perspective, and I think that's something a lot of our viewers are probably interested in. So here's the chart looking at Indiana farmland values for average quality land going back to 1970, and you've got 2 lines on there, so maybe explain how you got those.
Okay, so the bottom line is what us economists call nominal. That's what the value was on that date of the survey, okay? And then the top line is referred to as inflation adjusted, and so that's a trick that economists use to make the values all comparable, in this particular case, to the prices in 2019. Okay, so it tries to wash out the inflationary effects that are in the nominal numbers. And so you get larger movements in the what we call real prices, inflation adjusted prices. And you know, there's the famous bump that we had in the late 70s with the decline in the early 80s, and then kind of a steady rise. And then towards the end, things took off again with the ethanol boom. And you know, we peaked out in about 2013 or so, 2014, and we've been kind of drifting downward since then.
Yeah, so it took us a long time to take out the peak in inflation-adjusted values that occurred in the 70s. We finally did that about roughly 2012, 2013, peaked in 14, and then looking at those nominal values, down 12% since 2014.
Yes, that's right. So we have had a bit of an adjustment downward, certainly. You know, us economists like to think about land getting its value from the things that are produced on it, and the margins, and it's the kind of the residual claimant in the budget, and the margins have been tighter. So what's left for land is smaller, which says prices ought to come down, and we've seen a little of that occurring.
Michael, you've taken a look not only at the Indiana data, but you've taken a look at some of the data from the other states in the Corn Belt, and what's the picture look like there versus what we're seeing in Indiana?
Iowa has a long-term series similar to Indiana. In fact, I think their series might even go back further than 1970. And if you look at their land values, they peaked in 2013. So they peaked a year before the Indiana values, but the nominal values have came down harder when you look at the average productivity in Iowa compared to what we're looking at here for Indiana. It's closer to 16-17% decline from 2013 to 2019 for Iowa. That's a December 2018 is the latest information they have, so it doesn't match up exactly with what we're looking at here. But nevertheless, it's consistent, but a larger drop in Iowa. However, as you'd expect, they increased more. During that 2007 to 2013 period, Iowa land values increased more than Indiana, and so when it goes up faster, it's probably going to come down faster. Another thing that's really interesting about this graph, Craig, is, yeah, we've lost 12% since 2014, but we're still way above where we were in 2006, right before the ethanol boom. And so I think that's very important to point out is, yeah, we've made an adjustment, a fairly large adjustment, but we are clearly way above where we were before this ethanol boom started, and I just wanted to point that out.
Yeah, and well, we're not at the all-time high.
Yeah, no, we're not.
But we're
close.
Not too far from it.
Yeah.
Yeah, so the weakness is evident, but it hasn't been a collapse in land values, and I think that's, we're going to talk more about this a little later on some of the factors
And
driving
just looking
this.
at the last year, I should say something about that compared to Federal Reserve Bank surveys in Iowa. Very consistent with what is showing here in the Indiana survey. The Iowa survey is looking at drops about -1% or 1% drop for top, average, and low. So they were more consistent in terms of their drops across the quality levels. And so, even though they went down faster and peaked a year earlier, the last year has been very similar to Indiana. And also the Federal Reserve banks have been flat to down slightly, so they're also consistent with results in the Indiana survey.
Okay. So I think our next slide, Craig, maybe sheds some light on the factors that are driving change, and maybe that kind of leads into the discussion here, because I think there's one factor in particular we want to talk about. So you asked people about the factors driving change, and you've been doing that over time, and you've plotted those for us here. Let's talk about that.
Yeah, so maybe we can start with just a little bit of an explanation of what's on the horizontal axis here. You got to tilt your head just right to be able to read these things. But so we've got 10 different items here. The first one is net farm income, and then the growth that's occurring in land values or the decline, whichever way it happens to be going. Crop prices, livestock prices, interest rates, the alternative investments that you have where you could put your money somewhere else rather than in farmland, the export policies that we have, the inflation rate, the liquidity of the buyers in the market, and then the last one is agricultural policy here. And what we ask people to do is to think about these items and give us a sense of how strong or weak they are in terms of the action that they're exerting on the farmland market. And we let them rate each of these between 0 and 5 for a positive move, or between 0 and a -5 for a negative influence. And so everything that's hanging down below the line are negative influences, not too surprising, okay? One of the things that I've watched as time has gone on is that these bars used to be all above the line, and now they're most all below the line, which tells you that the land market has changed a little bit over the last 10 years. And so not too surprising, net farm income is a negative influence here. And that's, I guess again this year, that's the one that's the biggest influence of these 10, which is the same that it's been for the last couple of years, okay? Things that, there are still some positive things, I guess, interest rates being one. While last year it was negative, and a reasonably strong negative. You got to remember that's when we were in the midst of interest rates rising. And so that's kind of stopped now, or at least the Fed's no longer tacking on 0.25% onto the federal funds rate any longer. And we have discussions in the press about rate cuts rather than rate increases. So that's changed around. And so it's back on the positive side again, and long-term rates, they're not affected directly by the Fed, but they've been drifting lower, and so interest rates are still a positive in this market. Another positive is inflation. Okay, so the low inflation rates been steady, and that has made things attractive. People, the alternative investments, we've still got wide swings in the stock market. Since I'm getting close to retirement age, I tend to watch this closer than I used to. Although there are days I wish I'd quit looking. But especially when it goes down 800 points. So there's still a lot of volatility in the stock market. that's different than the land market, okay? We don't find large swings in the land market, and it still consistently generates, about 3% of your investment in cash rents and that sort of thing. So on the negative side, well, yeah, we've mentioned income, export issues are getting to be more of a concern here. The quick fix didn't occur, and it's dragged on longer than people had hoped. And now we're not sure how long it's going to drag on. And then the one that I really do find interesting is the very last one, dealing with agricultural policy. Because as I was growing up and learning my economics, people were always telling me about how the support mechanisms that we'd put in place to serve as a safety net in agriculture, that those benefits just got bid into farmland values. And, it helped the people that were there in place when they got put in, but everybody else, didn't matter to. And now we've gone from something that's supportive to something that's not supportive, which is a rather significant change in this. So, yeah, so I guess, again, this chart does show that there's not a lot of optimism in the farmland market at the current time.
Yeah, it's kind of a precursor to asking people, what do you think is going to happen for the next few years? And it highlights a lot of negatives. It also indicates to me, I think, the factors that people are worried about. They're worried about farm income. They're worried about where we're going with these export markets, because that's such a huge driver of prices and income in agriculture. As you pointed out, when they look at the 2018 Farm Bill, the safety net that's in there is not a very strong one compared to some prior farm bills, so they're worried about that. And then I guess the last one that I find kind of interesting is, if you think about, one of the drivers for farmland values over the last 10 years or so, and maybe think back to the question a lot of us get, which is, in this declining environment, is this a repeat of the 1980s? One of the big differences this time around is interest rates. In the 80s, the rapid run-up in interest rates was a huge negative on farmland values. We look at today's environment, and very low, both nominal and real interest rates, very low, being very supportive of farmland values.
Yeah, historically, even though they've come up a little, are at really low levels. And some people say, well, it's not where they are historically. It's where they were and where they are now that matters here. Yeah, there's some truth to that, certainly. But in the broader scheme, they're still far below what the average interest rate would have been over the life of this survey.
Yeah. So that's clearly, I think, indicates what people are thinking about when you start asking them about what's going to happen in the next year and what's going to happen in the next 5 years.
Yeah.
So, all right, let's take a look at what has happened and what people are anticipating happening here in the next few months.
Yeah, so as I indicated at the beginning, one of the things we ask people to do is to make a forecast of where farmland values are going to be by the end of the year. And so that's what this little chart kind of shows here. So we've divided 2019, or the very tail end of 18 and 2019, together here in a chart. So the first column numbers here is kind of what went on the first half of the year. And so that was a period when we saw some declines. And then the last column is the average forecasts for these three land qualities for the last part of the year. And people are expecting that those declines are going to continue here. Not big declines, but we're drifting lower in terms of farmland values.
I think you're going to talk about this later, Michael, but I think that's indicative of the pressure we're seeing on these contribution margins, right?
Definitely. This is consistent with the low net returns that we're looking at in 2019 and 2020.
So let's kind of summarize on the farmland value side what we found.
Yeah. So kind of the summary of this is that we had some strength early in the year, but that strength, or the end of last year, that strength seems to have waned. And for our June to June comparison, we had top and average quality farmland values down a little, and poor quality farmland sitting pretty stable. As we look to the end of this year, people are looking for a continuation of small declines on out through the end of the year. And I think one of the big drivers in the market currently is just the increased uncertainties that we face. You know, who would have thought when the year started that we would be planting corn and soybeans yet in the middle of June?
Or the end of June.
Or the end of June, yeah, or didn't plant at all in some cases. You know, those sorts of springs we aren't accustomed to. And so, you know, we're now in a position of trying to figure out, well, how big might this crop be? And so we've got not only the yield uncertainty, but the acre uncertainty associated with that. So, and of course that has an influence on prices. And you know, the export picture doesn't really seem to be getting much clearer. You know, and so there are concerns about that. You know, it'd be nice to return to something more normal, but we're not there. And we now have concerns about economic growth, not so much maybe in the U.S., but in the rest of the world. And that certainly has an influence on our other trading partners that buy corn and soybeans and that sort of thing. So, you know, maybe the one bright shining spot that's left are interest rates here. They've been fairly stable or favorable in this process. So lots of uncertainty.
And I think that's important to bring up that interest rate, because when you look at how land values and cash rents track, land values are dependent on net return to land and interest rates, where cash rent is only net return to land. And when we were sitting here last year doing this webinar, we were concerned about the increasing interest rates and actually saying that land values were probably going to go down faster or harder than cash rents. Even though we predicted small changes, we thought land values would have more softness than cash rents. This year, when we're doing this webinar today, I don't think that's the case necessarily. I think they're going to track the land values and cash rents. If they both go to, if one goes down 2%, the other one's probably going to be similar, because interest rates is more neutral.
Yeah, good point.
Yeah, and if you look at the rise in land values that we had from the middle 80s to just recently, you got to remember that in that period, interest rates in general were moving in one direction, and that was down.
Yeah, and even in the last 10 to 15 years, you go back 15 years from now, land values went up faster than cash rents. That was largely due to interest rates continuing to decline and staying relatively low. And so that's a big deal, the fact that interest rate policy has changed. That's huge for the land market.
Yeah, so for a capital asset like land, interest rate policy makes a big difference on what happens with respect to prices. All right, let's kind of shift gears and talk more specifically about cash rents. We've kind of alluded to that in terms of what at least Michael thinks is going to happen here going forward. Let's talk about what people were telling us on the survey.
Talk about our history here. Okay, so this year again, well, not again. Last year, when we did the survey, we had rents going up across all qualities of farmland. This year, we got the reverse. And so we had top quality land declining by a little less than 5%, average about 1.5%, and then poor just a bit over a 1% decline. So again, I think this reflects the pressure that exists in the market, that we're still trying to find that magic equilibrium point in the market. We're not there yet, it would appear. And so it may vary with the tight margins. These results aren't surprising, I don't think. And as we look forward, I suspect we may see some additional declines in cash rents.
Yeah, when I looked at these numbers, Craig, particularly in that top quality land, a cash rent decline of 4 to 5% strikes me as a relatively large one-year decline.
Yes, yeah, it is. That is a large one-year decline.
And then as you look ahead, Michael, you've done some work on this with respect to some modeling using Indiana values. That work would suggest some long-run changes taking place.
If net returns stay where they're currently at, the last 3 or 4 years, they've been down around that $200 per acre for West Central Indiana, for example, and whereas the cash rent's now at $240, and we'll have a diagram here a little bit showing that. But if net return to land stays well below that $240 cash rent, it's obvious what has to happen. They have to eventually meet, and so cash rents will have to come down to meet that net return to land. Now, having said that, there's no reason why they have to stay at that $200 level. If we have some higher prices and continue to have some growth in yields, not this year, but perhaps moving forward, that certainly would help net returns.
So.
Or finding other ways to cut costs.
Yes.
All these things work slowly.
Yes. And the last 6 years, that's a good point, Craig. We've relied heavily on fertilizer and cash rents. Maybe there's some other cost out there that we can cut.
Well, and just the kind of natural growth of farm size.
Yeah.
That kind of addresses the fixed costs, I guess, associated with farming. But farmers are smart people.
Yeah. They will make adjustments.
That's right.
Yeah.
There will be adjustments across a whole host of things.
But having said all that, we're not seeing any evidence for upward pressure on cash rents.
No.
Right? So the debate's going to be flat to down, I think.
Yes, yeah. I'm not arguing that they're going to rise.
Let's take a look at the history here. You've got a nice chart going back to the mid-'70s on cash rents.
So here's our cash rents picture again. We got our inflation adjusted, the top line, nominal bottom line, and we had the booms of the 70s, the crash of the 80s, and in real terms, we went for a long period of time where things were fairly stable in the cash rent market. Now, nominally, they were going up, okay, but when you try to take inflation out, well, the land, the line through there turned flat. Okay, so what that increase was basically inflation, and then the ethanol phenomenon took off, went up, it fizzled out, and we've come down a bit here as well. And again, so from the peak, cash rents have come down about 11%. Okay, and so. Michael talked about the link between rents and land values. So, there's a little difference in how much things have adjusted, but, they're related here, certainly.
Yeah, so we're seeing that decline underway, and I think going forward, we're going to ask what the people on the survey had to think about the future, but we're not seeing any reason for that line to do anything but either flatten or actually continue to come down. So let's take a look at what people were telling us on the survey.
Yeah, so, quite often people are in the no change camp, and that's true here. 40% of our respondents were there. Don't see much of change occurring. There were 19% of our respondents that said things were going to move up. 34% said they were going to move lower. And then there's always the question, well, if they're going to move, how much are they going to move? And I'm always surprised how one just about offsets the other for whatever reason. The people that thought they were going to go up, they were going to go up 8.4%. People thought they were going to go down, they're going down 8.6%. And so, there were more people that thought it would go down. So overall, we got an average that says a decline of 1.3% here. So we're in that camp. There's more pressure down. as well as these respondents. They see more pressure down.
And we're probably going to see some variability in terms of some cash rents probably had a larger adjustment here in 19 than others. So when you look at it on an individual basis, there's going to be some disparity. But when you talk about the overall picture, again, this points to stable to maybe a small decline for cash rents in 2020.
Yeah, so this is a good place to remind people about averages, I guess. Okay, nobody's average. Yeah, there's a lot of variability in the market, certainly. I like to read the comments that people send when they turn in their surveys. And there was one individual that indicated, well, you know, my tenants are going to have lower cash rents next year, okay? And that probably reflects the fact that they may have had long-term leases where there hadn't been adjustments yet. And so, yeah, they got, you know, they should be lower now. And so, yeah, there's a lot of variability. Everybody's case is a little bit different. And so, quite often the general trends may not be what an individual is experiencing.
At least in that particular year, but nevertheless, from a longer term perspective, this is the trend we're seeing in the marketplace.
What I'm a little surprised, I'm not surprised at the 1/5 saying that cash rents could be higher. I think that's fairly typical to have, have divergence in opinions. I'm a little surprised at the 8.4%. That would be a rather substantial change in cash rents and really would make up for about half the decline.
Yeah.
More than half the decline that we've seen.
Yeah,
so
yeah.
That's a little surprising.
Yep.
And Craig, as I think about when you did the survey, it was during the month of June. Of course, that was a time frame when commodity prices were going up, not only for the 2019 crop, but we were seeing significant increases in those deferred futures out as far as the 2020. And I wonder if some of those folks were looking at the rise in commodity prices and projecting based on that.
So are you suggesting we ought to sort these by time of receipt and see if they were more optimistic than the early ones?
That would sort of be my hypothesis. The people in late June, before the 28th of June, which is when the USDA report came out, might have been a little more optimistic than those that filled it out the first couple days of June.
That could very well be.
Michael, you've taken a look at cash rents and estimated net returns to land. That's what this chart's about.
Yeah, the line here is the cash rents for West Central Indiana average productivity, and so it's pretty important to point that out. It's only for West Central Indiana, and as not too surprisingly, cash rents are fairly sticky. They respond slowly to changes in net return to land, and so it took several years in a row a very high net return to land to bring those cash rents up. To reach the peak in 2014. And similarly, it's taken several relatively lower net return years to take cash rents down. And so that's pretty obvious from this chart that cash rents are a lot less variable than net return to land. I think that makes a lot of sense. But what I want to make point I want to make with this chart, and it's really hard to estimate net return to land for 2019, but I've estimated here in the chart at $150 per acre. That might be as high as $200 per acre, but it's probably closer to $150 than the $200, given how much corn was planted late and given the adjustment in corn prices that we've seen recently. But the point I want to make here is the difference between that cash rent and the net return to land matters. If that net return to land stays relatively low, like it's been since 2014, we have to lower cash rents more than we've already lowered them. Simply because eventually those two have to meet. To reach equilibrium, those two have to meet. And so the way to think about what people are doing when they're negotiating cash rents is there must be some people thinking ahead, thinking, well, returns are going to increase. For whatever reason, we don't know what their reasons are, that returns are going to increase. Because if they don't, again, we clearly have some downward adjustment on cash rents.
So I think two things to think about looking at that chart. One is that just because there's a gap between cash rent and the estimated net return to land in a given year, that gap doesn't cose the next year.
No, it takes a long time.
Whether they're going up or going down, it's a market that adjusts more slowly. Let's go more specific here. If that net return to land stayed at $150 to $200 for the next 5 years, you're looking at cash rents dropping at least 5%.
I've done some modeling looking at that, but that's if those net returns to land climb a little bit and get above $200, closer to that where cash rents currently are, no adjustment. And so the key thing to look at, of course, if you're a landlord out there and you're wondering about negotiations with operators, is where do you think net returns to land are going to be? Not only next year, but 3 years out, 5 years out.
So I think thinking about the models that you've worked with one of your students, when you looked at that gap between net returns to land and cash rents, the adjustment factor was...
It's pretty low short term. The adjustment factor is only 10%.
So 10% of that gap would be reflected in a change in cash rents.
Yeah.
In the
so if you had a $100 increase, for example, you had a $100 increase in 2020 for whatever reason, that would be a $10 increase in cash rent short term. Long term, the adjustment's more like 50%. So $100, if it was a $100 change permanently, so a long-term change, that would translate into a $50 increase in cash rent.
Okay. So that kind of helps us out a little bit. So what happens in a given year is important, but it doesn't give you that complete shift. It takes a number of years for that to take place. So let's kind of summarize, Craig, on the cash rent side.
Okay, so this year we had a decline of between 1.2 and 4.6%. And when we asked respondents what they thought was going to happen in the future, they thought there'd be another small decline coming in the future. And so again, we've got this situation where there's more downward pressure on cash rents than there is upward pressure. And if one wants to go back and compare things to the peak that we reached in 2014, nominal terms were down 11%, in real terms we're down 18%.
So, and as you think about it from a long-term expectation perspective, let's take a look at that a little bit here.
Okay. So we like to get people to think longer term, and we as economists think that cash rents and land values have some link to the price of corn and price of soybeans, and so that's what our bars are here. And so the question that people have responded to here is, what do you think corn and soybean prices are going to average over the next 5 years? And you can see that they go up and down a bit every year. But for this survey, corn prices turned out to average, people think they're going to average around $4.15. Soybeans are going to be around $9. Okay, so we think that gives some context to what people think is going to happen out into the future 5 years. Now, as Michael has pointed out, land is also very sensitive to interest rates, and so that's our top line here. For the last couple of surveys, interest rates have been, or their expectations have been pretty much the same. And so no big changes there. Inflation, again, no big changes in that expectation either, okay? So that gives us a context of what might happen out in the next 5 years.
It does. So I guess I'd like to highlight those prices a little bit. I find it interesting that people reduced their expectation for soybean prices this year versus what they told you last year by $1 a bushel. Mm-hmm. Last year they were at $10. This year they're at $9. That's a big move. Mm-hmm. And on the corn side, I think reflective of what was going on in the month of June, people were a little more optimistic about corn prices. Last year they were at $4 a bushel on corn over the next 5 years. This year they said $4.15.
Yeah. Yep. Yeah. So I think that's. Yeah, I mean, I think the thing in the soybean market has to be exports primarily. That there was hope last year that this embargoing or tariff stuff would be short run. It's turned out to be a longer run than what I think many people had hoped that it would be, certainly. So they're a bit more pessimistic this year, and I think that's not at all surprising. And I think, the discussions around the difficulty of getting things planted in terms of corn and soybeans this year did find its way into the market, and we got some upward movement in corn prices.
Yeah, very much.
And so I think that helped people's outlook, especially those that return their survey later versus the first thing in the 1st of June.
You know, I don't know if you're going to ask us, Jim, you know, whether we're bearish or bullish with respect to 5-year prices, but let me put my 2 cents in there to get it started. You know, the 4.15 corn, you know, anything above 4 is really right at break even. There's quite a few producers with a break even under 4, you know, counting all costs, and so you know that's a pretty important to point out. Now the soybean price there is under the break even. The break even is probably closer to 9.50, 9.75. But when you look at those prices there and you look at the interest rates, I think, you know, stable land values 5 years from now would not be that far off.
If those are realized.
If those are realized.
Yeah, that's a good point. Okay. All right, let's take a look at the survey of respondents looking ahead 5 years.
Yeah, so we asked our respondents to look ahead 5 years, and not, you know, too surprising, 58% said they were going to go up. I mean, that has been the history of farmland values. You know, they're more next year than they are this year. That's what that earlier graph showed. You know, generally they go up. You know, we had the 80s when we got that big downturn, but generally they go up, okay? 29% thought there'd be no change, and only 13% thought in 5 years farmland values would be lower than they are today.
So then you did a little aggregation here.
Yeah. So are these optimistic forecasts or pessimistic forecasts? And so that hinges on whether no change is an optimistic forecast or not. So if you put the no change with the decrease, we're at 42%. If you put them in with the people that are the increase, that's 87%. So maybe the outlook isn't as gloomy as we kind of like to make it sound.
Well, I think we were talking about this earlier. If you look at it from a long-term perspective, and since World War II, for example, there's really only been one 5-year period when farmland values were declining, and that was in the 80s. However, the current environment is getting perilously close to being in that second time, right? Yeah,
you know, if you think about, let's say, 14. And we're at 19, pretty soon we're going to be able to say that 5 years later, farmland was less than it was at the peak.
5 years earlier, right?
Yeah. Yep.
And Jim, this is hopefully some people in the audience are familiar with the Ag Economy Barometer. One of the questions we've been asking on a fairly regular basis is a question very similar to this: what are their expectations for farmland 5 years out? And I think these results, correct me if I'm wrong, Jim, are very consistent with what we've been finding from the respondents of the Ag Economy Barometer survey.
Yeah, I think the most recent barometer was in the upper 50s in terms of expecting an increase. And I think the other thing that I guess the point I was trying to make is that when people say they expect farmland values to go up over the next 5 years, what they're really saying is they're betting on history. Historically, there's been a very strong probability that we would see farmland values go up over any 5-year time frame. And so when people, that 13%, that's a group of people that have a pretty negative perspective on farmland values, because that's very unusual in the history of farmland values, at least over the last roughly 70 years or so.
Yeah, and it's not just up. It's up substantially. We're talking about 40 and 50% increases over 5 years. So this isn't just a little up historically.
Yeah, good point.
Yeah, I think the average increase is 8 to 10% since 1960. So that's the average.
Okay.
But I think it also, I think you're right, Jim, that the point you've made there. But I think it also relates to optimism. I think there is more optimism, 3 to 5 years out than there is 1 year. I'm certainly more optimistic about where profitability is going to be for agriculture 5 years out compared to today.
That surprises me. You would be
I'm not Dr. Doom.
You would be the optimist in the group here. All right. So with that, let's kind of summarize some things here. We had some reasons for downward pressure on cash rents and land values. And
right.
Seems to be a long list.
Yeah. Well, Yeah, it's a longer list than it was. So anyway, I think as we look forward on cash rents and land values, we still have this cloud of tight margins hanging over us here, and so farmers are still working to try to get their costs of production down, and part of that is working to get cash rents down. And as we think about land values, they're certainly influenced by the same things, but there are other things that influence farmland values. Interest rates are a big one, and then there are just these risks that we seem to have today that we really didn't think a whole lot about a few years ago. So our trade policy change of direction here. This year is kind of unique in that we've got more uncertainty about how large the corn and soybean crops are likely to be, although we've got plenty of carryover to get us through a small crop. But that's still another uncertainty that we've got. And then we're still sitting at a point where there's a relatively high, what we'd refer to as in the stock market, the PE ratio, the price versus the cost of the stock. We still have, and we'd use rent and then farmland values to talk about kind of the same thing here. We're still at a relatively high point in that. It's kind of stopped going up, but it's still fairly high, relatively speaking.
And let's just take a look at that chart, because I think that's your next chart.
Right. Yeah. So, here it is. And so what this chart is about is how much are people willing to spend for $1 of income from farmland. And back in the 70s, where some people would say that we were more sane, people were only willing to spend 13 times cash rent to get $1 of farmland. Okay, as the 70s wound down, we got up to 21 times the rent value. And then we corrected it back to a little bit lower than we were when our surveys started here, at 12 times cash rents in about 85, 86 when we kind of hit the bottom. And we've been steadily marching up since then until now, where we've kind of, we have flattened out, okay? But we're still up there at 33, 34 times current earnings to buy an acre of land. And why have people's opinions changed so much?
Well, I'm going to turn to you, Michael, because we mentioned this earlier, but when I look at that chart, especially starting at about 1985 up till just recently, a chunk of what was driving that was the fact that interest rates were declining sharply over most of that period, virtually that entire period. Yeah. So weak or low interest rates, or more importantly, declining interest rates, was pushing that ratio up over time.
Yeah.
The flattening more recently could be related to the fact that we haven't seen a lot of movement in interest rates lately, right? There's been, a year ago we were worried about interest rates going up. Right now we're talking more about interest rates going down, but the long-term secular decline in interest rates appears to be behind us, at least the biggest chunk of it, which would suggest there's not much potential for increasing that ratio from the current time. Is that right?
Yeah, that fits my argument, yes.
Okay. I would concur with that. I think interest rates were largely responsible for what we're seeing on the screen here.
So going forward, as long as interest rates stay where they're at, that's going to continue to support that ratio, maybe somewhere in the ballpark of where it is.
Yeah, when I was saying earlier that land rents and cash rents may track one another, that means a steady PE ratio or a steady P-rent ratio or land value to income multiplier.
Yeah, because I think some people have looked at this chart and say, well, that's unsustainable. we can't keep the PE ratio that high. And I don't think, as a group, I don't think we agree with that, because we feel that that ratio is keyed so heavily off of interest rates. Is that right?
Yeah, I think that's right. I don't, there are lots of things that are behind this, interest rates being one of them, and an important one. But there are lots of other forces that have pushed what people are willing to pay for land in order to possess it upward. And those forces probably haven't changed much.
And even though this looks really volatile compared to the stock market, this is flat.
Yes.
The stock market PE ratio does a lot larger increases, a lot larger decreases. And it goes back to the fact, I think we alluded to it earlier, land values are, even though they go down, they're more stable than the stock market. And that's one of the reasons why we have institutional investors looking at land values, is it fits well in a portfolio, having both stocks and land.
Yeah, and they generally move in the opposite direction of stock values. When stocks are going up, land may be flat.
Yeah.
But when
stocks are going
unrelated.
Down, I mean, they're either unrelated or moving the opposite direction.
Right.
The key there is they're not moving in tandem.
Yeah.
Right.
Yep.
All right, let's kind of summarize our findings here. Craig, I'll let you do that.
Okay, so as we've said before, this year in our survey we had a bit of a decline, and so top quality land was down a little over 5%, average was around 1% lower, and then poor was at 0. Over a 5-year period, most of our participants and ourselves probably think farmland values are going to be a little higher than they are today, but there were still a few that said they were going to be lower, and there was another group that said they didn't expect much change at all from over 5 years. And again, as Jim has pointed out, that's an unusual phenomenon in the land market.
Let's look on the cash rent side.
Yeah, so cash rents again, we've still got pressure downward, and some of that got translated into our results for this year's survey, down 1.2 to 4.6%. Many of the respondents expect that the rents in 2020 will be lower as well. Let's see, our value to income multiple here still is high, and as long as interest rates remain fairly stable, I guess I would expect it to also remain fairly stable for us. And I guess it's not all doom and gloom in the farmland market. It has an ability to adjust supply of land on the market when things get uncertain. There just seems to be a natural contraction in the supply, the amount of land that's being brought to market. And that's been a big factor as well in holding up farmland values. That the thing that really caused farmland values to drop a lot in the 80s was the flood of land that came onto the market. There was just too big a supply on the market there,
in a short
span of time, for people to adjust without a significant decline in farmland values. That hasn't occurred this time around. It's been a more orderly process, and so we haven't seen the big drop in farmland values. But the market does work. They have come down some.
So I think one of the things we wanted to do here is maybe put each of us on the spot a little bit and say, what do you think is going to happen with respect to cash rents and farmland values? I'm going to start with Michael.
I think short run, the next year or two, I think there's going to be downward pressure on cash rents. I think further out, we're looking more stable. 5 years out, I don't see any reason why cash rents would necessarily increase 5 years out, but I think they'd be more stable, closer to 0% further out.
Okay, Craig?
Well, cash rents, I guess, short term, I would agree with Michael that they're likely to be a bit lower as we go forth the next year or two. As we go out further than that, I may not be quite as optimistic as Mike that they're going to hold steady. I suspect that in 5 years we're likely to find cash rents are indeed lower than they are today. Not a lot lower, but some lower. But there are a lot of things that are going to happen in the next 5 years.
Yeah.
But as I sit here today, my sense is, for whatever reason, there's been a bit of an increase in the uncertainty and the risk associated with production agriculture. Part of it is government driven, okay? But the other part of it, I think, is somewhat climate related. Now again, we don't have a long history, but certainly the short history seems to indicate that things have gotten a little more variable. Now, maybe this is something that's not going to last long term, but I think we're in a period of time now where we do have a different kind of weather events occurring. Certainly this year was different than it has been in the past.
An anomaly.
Wet up until the end of June and then dry, sort of thing. So, maybe I don't know what I'm talking about. Highly likely, but it just seems to me that at this point in time that there's a bit more variability that's going on than what we've had in the past. And if that's true, then people are going to demand a bigger return for that risk that
risk
they're taking.
premium. Yeah,
definitely.
Yeah, good point. Well, I'll put myself on the spot. I guess I'm probably a little closer to Craig on the farmland cash rental rate perspective over the next several years. I think we're probably going to see some continued downward adjustment. I think we're in the midst of a longer term adjustment in cash rents, and so I think maybe some continued downward pressure. Farmland values are tougher. It's hard to bet on farmland values going down over that long-term time frame. I'm going to condition that one on interest rates. If we see interest rates remain stable, then I'm being a little more optimistic about farmland values either being steady or maybe slightly stronger over the next 5 years. If something happens and we see interest rates go up, though, that is very negative for farmland values, I think would be my take.
One of the wild cards here that we haven't talked about, but we probably should at least point it out, is this is all conditioned on financial stress staying similar to where we're currently at. If returns would stay relatively low for several more years, financial stress would increase, and that may put a little more land on the market. But we're not anticipating that, and so all our predictions, I think, it's safe to say, are conditioned on financial stress not getting much worse than what it currently is.
But having said that, if it stays about where it is, from my perspective, that continues to put some downward pressure.
Oh yes, it's definitely downward pressure.
Yeah.
There's no doubt about that.
Yeah. All right, so if you want to read the full report, that's available on the homepage of the Center for Commercial Agriculture's website, so www.purdue.edu/commercialag will get you there, and it's right there in the front page, along with the rest of the Purdue Ag Econ report. And then our next webinar is going to come up on September 13. USDA is releasing the crop production report and an updated world ag supply demand estimates on the 12th of September. So that following day, Michael Langemeier and I, along with Chris Hurt, will take a look at those numbers and try and interpret those for you, and then actually make some projections of our own with respect to making some marketing recommendations. So we hope you have a chance to join us for that webinar. You can tap into that by going to our website, and there'll be an opportunity for you to register for the webinar. So with that, on behalf of my colleagues in the Center for Commercial Agriculture, thanks for joining us. We'll look forward to visiting with you next time.